Hello, and welcome to Session 5 of the Basic Tax course. We are going to start Session 5 with a review of the Session 4 quiz. Most frequently missed questions. Number 1, your divorce decree states that your ex-spouse shall pay you $1,000 per month until your child reaches the age of 18, when payment shall reduce to $500 per month. During the year your ex-spouse fell behind on support payments, you received support payments totaling $7,000 for the year. Which of the following statements is true? A, you should report $1,000 as alimony income on your return for the year. B, you should report $6,000 as alimony income on your return for the year. C, you should report $7,000 as alimony income on the return for the year. Or D, none of the above. Well, the correct answer is A. You should report $1,000 as alimony income on your return for the year. Now let's talk about why. Anytime a divorce decree states that alimony shall be paid and there is some sort of contingency related to a child, that contingency is child support, regardless or not of whether the divorce decree says that the whole payment is alimony. If it is reduced when a child reaches a certain age, when a child leaves the home, or when the child graduates from college, that portion that is being reduced is considered to be child support. So in this question, it says that you will receive $1,000 per month until your child reaches the age 18, when the payment shall reduce to $500 per month. We can tell by this that the $500 per month is considered to be child support and is not taxable on your federal tax return. So we take $500 per month times 12 months for the year, and that equals $6,000 of those support payments to be considered child support. Since the ex-spouse only paid $7,000 during that year, we take the $7,000 minus the $6,000 that's considered to be child support, and we end up with $1,000 considered to be alimony, which is taxable and should be reported on your 1040. Let's take a look at question 2. You have won and received a $10,000 scholarship to OSU for academic years 2012 through 16. You are a full-time student and a degree candidate. For academic year 2012, you received $2,500. During 2012, you spent $1,500 on tuition, $700 on books, and $2,000 on room and board. How much of your scholarship is taxable on your 2012 federal return? Well, the correct answer here is A, $300. And you may wonder, well, you spent more than $2,500 during the year, but the key here is what is considered a qualifying expense for education. Tuition and books are considered qualifying expenses, but room and board is not. You've received $2,500 for school year 2012 of your $10,000 scholarship, and during that year, you spent $1,500 on tuition, $700 on books. That adds up to $2,200. So you take the $2,500 that you received during that academic year, subtract out the $2,200 spent on qualifying expenses, and you are left with $300. And that $300 would be reported on line 7 of the federal 1040 as taxable income. The next frequently missed question is number 7. John got lucky in Las Vegas. He won a $5,000 jackpot and won an additional $400 playing blackjack. John also lost $1,000 at the track. How much gambling income should John report on his return? Well, simple. He reports all of his winnings on the return. You are required to report all winnings. If you choose to take a deduction for your losses, you will be doing so on Schedule A, itemized deductions, and we will get to that later in this course. But always remember that the entire amount of gambling winnings are fully taxable on your federal return regardless of your losses. So since John won $5,000 jackpot and additional $400 playing blackjack, then he will report $5,400, which is answer C. And our last frequently missed question on Quiz 4 is number 10. Let's take a look at this. Sherwood received disability income of $6,000 for 2012. All premiums on the health and accident policy were paid by his employer and included in Sherwood's income. In addition, he received compensatory damages of $10,000 as a result of an inadvertent poisoning at a local restaurant. He received no other income for this year. How much income must Sherwood include on his 2012 tax return? Well, the answer is 0. And let's go ahead and take a look at Pub 17, and we'll see what it has to say about this. It says, in most cases, you must report as income any amount you receive for personal injury or sickness through an accident or health plan that is paid for by your employer. If both you and your employer pay for the plan, only amount you receive that is due to your employer's payments is reported as income. Well, let's take a look at Sherwood's situation. All the premiums on his health and accident policy were paid for by his employer, but in this situation, they were included in Sherwood's income. Since they were included in Sherwood's income, he has paid tax on those premium amounts, and it is just like him paying for the premiums out of his own pocket. So he will not have to report any of the income for that item on his 2012 return. Let's also take a look at Pub 17, page 52 and 53, and we'll see what it says about compensatory damages. Okay, this is Pub 17, page 52, other compensation. Many other amounts you receive as compensation for sickness or injury are not taxable. These include the following amounts: compensatory damages you receive for physical injury or physical sickness, whether paid in a lump sum or in a periodic payment. The $10,000 he was awarded was a compensatory damage amount, and as Pub 17 says, that is not taxable to you. So Sherwood will enter 0 for income on his 2012 return. And that concludes the Session 4 quiz review, and it's time to move on to the lecture portion of Session 5.
We're just going to move on now to page 2 of the manual, and we're going to begin with employee pensions and annuities and with some definitions. And there's a couple of definitions that should become just part of your regular vocabulary as a tax preparer if they aren't already. The first one is contribution, and in the world of pensions and IRAs, contribution means to put money into your retirement account, and distribution means to withdraw, take, or receive money from your retirement account. And when you make a contribution, the contribution is acknowledged, or the IRS is informed about the fact that you made a contribution in a variety of different ways, and it depends on how you made the contribution and where that contribution was made. If you make your contribution to your retirement account through your job, your employer is going to usually make an indication of that fact and the amount of the contribution on a W-2. And I have an example of a W-2 in front of you now for a character named Buck Rogers. And Buck Rogers works for Earth Alliance. And you can see in box 1 of his W-2, it's showing $105,000 of wage, but when you go down to boxes 3 and 5, the wages are actually $122,000. Well, if you take the amount in box 12 with a code D next to it, it says $17,000. And if you add $17,000 to 105, you get $122,000. So this W-2 is telling me that Buck Rogers made an elective deferral to his 401k plan on his job in the amount of $17,000 for the year. This information is, of course, also provided to the IRS. Now, there is more than that that's going on with this pension plan. Of course, the employer has to file Form 5500, and that's going on in the background. But today's class is not about employer issues with pension plans. It's more about what the employee does or the retiree does when they receive income from pension plans. And so I just wanted to start off with some definitions, and very briefly, this first one is contribution and how an employee might make a contribution to their employer plan. They would typically do it through a salary reduction plan at work, but there are, of course, other ways of doing it. Moving on to the next page of the manual, we come to Form 5498. And in the world of tax forms at IRS, this is still a relatively new form. It's been around for a few years now, but I've been in this business now for 21 tax seasons. And in terms of how long 5498 has been around, it's something that happened fairly recently. Contributions to an IRA are reported on Form 5498, and Form 5498 is submitted to the IRS by the custodian of your individual retirement account or arrangement. And it is used to report the following information about the IRA that you own. It shows contributions, including rollover contributions that you made to your IRA during the year. It also shows Roth IRA conversion amounts, recharacterization amounts, and the fair market value of your account on the last day of the year. It also will indicate whether or not a required minimum distribution for the year is required. Amounts shown on the form may or may not be reportable on your tax return, and in fact, most of the time when my clients bring me this form, I do nothing with it. It has no impact on the tax return at all. It's just showing the year-end balance in their account for most filers. But there does come a point in time where a person is age 70 and a half or older, and they will begin to be in a position where required minimum distributions must be happening regularly every year. And if that's the case, then we would look down and we would see that there is a required minimum distribution amount in Box 12B, and we would want to make sure that that client actually did take the required minimum distribution for the year. And then it also shows, of course, what type of IRA it is, whether there were rollovers into the account, whether there were contributions to the account, and if there were rollovers, contributions, conversions, recharacterizations during the year. This form will tell us that those things went on. But for the average taxpayer, very rarely does much of that go on at all. And so most years when I see this form, it's just telling me the fair market value of the account on the last day of the year and the type of account it was, and that's pretty much all I normally see filled in on it. However, we shouldn't discount the form because we should still be reviewing it and making sure that if it does contain relevant information, we know what to do with it. So contributions to any IRA are reported on Form 5498, and if no reportable amounts were made during the year, only boxes 5, 7, 11, 12A, and 12B, if applicable, will be completed. So again, only 5 and 7 will normally have any indicators on them at all. And if a required minimum distribution must be made, then we will see information reported in boxes 12A, 12B, and 11. Direct rollovers, transfers, and recharacterization. A direct rollover is reported in Box 2. Conversions and recharacterizations are reported in Boxes 3 and 4. And then finally, the required minimum distribution. If you are required to take a minimum distribution from your account and you fail to do so, it's a pretty hefty penalty, 50%. Don't see the required minimum distribution fail to happen too often. And in fact, on all the years I prepared tax returns, I used to say that I had never seen a client who ever failed to make a required minimum distribution because they were always on top of that. And then this tax season, I ran across 2 clients who had failed to take the required minimum distribution. One was a lady who had been placed in a nursing home by her son because she's got Alzheimer's, and basically her old CPA was not staying on top of that, and the son didn't know any better, and so that distribution did not happen. And the other one involved an inherited IRA, and the woman simply didn't know that she was supposed to do something with that, or she'd received letters from the plan administrator, didn't really understand them, so she did nothing. So now I can say I have seen it happen, and we should be on top of it. All right, moving on now, we're going to talk about Form 1099-R, and 1099-R is important because 1099-Rs are used to report distributions. So I showed you a W-2 with a code D in Box 12. I showed you the Form 5498 to show when contributions are being made. Now we're going to talk about the other side, or the opposite, which is to take a distribution. And Form 1099-R is used to show that a distribution has been made. And when you receive a 1099-R, your job is to establish how much of that distribution is taxable to your client. If the 1099-R shows that the IRA box is checked, then you would enter the distribution on line 15A. And if it shows that the IRA box is not checked, then you enter the distribution on line 16A. And then, of course, we have line 15B and 16B, and that's where we enter the taxable portion of the distribution. Here is a Form 1099-R. And one of the things I'm careful to do when I teach classes is I like to cover some of the stuff that is often considered to be so basic, it almost seems a waste of breath to discuss it. And yet, when we stop and slow down and look at these really basic concepts, sometimes we learn things we didn't otherwise know. And so today's class will be no different in that regard. We're actually going to take a look at the 1099-R and take it box by box, in other words, looking at some of the more important features that should be known about it. Box 1 is used to show the gross distribution that was taken from the account, or came from the account, or was distributed from the account. Box 2A is the taxable amount. As often as not, Box 2A is blank, and when it's blank, Box 2B will be checked, which says taxable amount not determined. Most of the time when people receive distributions from their 401k plans, they have no basis, which means the entire distribution is taxable. But even when the entire distribution is taxable, it's still possible to see that Box 2A is blank and Box 2B has a check mark in it. So as tax practitioners, we should be aware that the fact that 2A is blank does not mean it's not taxable, that we really need to learn the facts and circumstances of our client's situation and help them establish how much, if any, is taxable, working off the understanding that nearly all the time it's always fully taxable. And there are certain situations where it may be partially taxable or non-taxable, and we're going to learn about some of those today. And of course, if the total distribution box is checked, that means that the account was completely liquidated. Either all of the money was distributed or all of the money was rolled over into another account. We then see the capital gain that was included in Box 2A. If Box 3 has an amount in it, which it almost never does, and here's why it almost never does, it means that a portion of the distribution would be eligible for a form of capital gain treatment, long-term capital gain treatment. And the reason Box 3 will almost never have a number in it, and you'll see it right down here at the bottom under the description, is if it does have a number in it, then it means the employee was a participant in the plan prior to 1974 and was born before 1936. And there's more rules involved with it than just that. And we'll talk about that type of distribution, which is a lump sum distribution, a little bit later on today. Box 4 is where federal income tax withholding should be entered, and usually I see some form of federal income tax withholding unless we're dealing with rollovers or unless the amount of the distribution is fairly small. Box 5 is where a cost, if a cost has been recorded by the plan administrator, will be entered. And so Box 5, if I just scroll back up to the top, if the participant in the plan has a number in Box 5, that number in Box 5 may represent their cost in the plan. And to the extent that Box 5 has a number in it, you may see a calculation go on where Box 5 plus Box 2A equals Box 1. No guarantee that that's what's going to happen, but it's been my observation that sometimes I see that. But most of the time, Box 5 is blank. And moving on down, Box 6 usually never has a number in it. Again, we're dealing with lump sum distributions with people born before 1936, fairly rare animal. But Box 7 is an all-important box. I want to spend a couple of minutes talking about Box 7. Box 7 has a code in it. There will always be a code in Box 7, and the code that appears tells you what kind of distribution happened for this particular plan participant. And as a practitioner, I think every practitioner should have the most common codes memorized. So in other words, if you pick up a Form 1099-R that your client has given you and you look at the face of the form and the Box 7 has a particular code in it, that if that code is one of the most common codes, you automatically know what it means. And let's look at some examples of what the codes are. Code number 1 means that there was an early distribution with no known exception to the early withdrawal penalty. So in other words, if you pick up a 1099-R and box 7 has a code 1 in it, it automatically means that probably your client is going to owe an additional 10% tax. There may be an exception to the 10% tax, but the starting point is that they are going to automatically be assessed a 10% tax by the IRS if we don't address it. And so if we enter code 1 into our computer software, odds are the computer software will know to put the 10% additional tax on the return, and then it's our job as a practitioner to determine whether or not an exception is possible where perhaps they don't have to pay the penalty. Code number 2 is an early distribution where an exception does apply. In other words, if there is a code 2 in the box, then it means they are under age 59 and a half. That is, the person who took the distribution is less than age 59 and a half. And so they should be subject to a penalty, but the plan administrator believes they're eligible for a particular exception and therefore they don't have to pay the penalty. Code 3 in box 7 means that the taxpayer is disabled and they're receiving that distribution because they're disabled, and typically that means that there's no penalty because they're disabled. Box 4 means that this is a death benefit or an inherited IRA, and when you have an inherited IRA, there usually is a required minimum distribution each year that must be made, and of course it also means that they're not going to be taking or subjected to penalties on those distributions if they're under age 59 and a half because it's a death benefit. Box number 5 is a prohibited transaction, and we go on to some others here like Section 1035 exchange. Probably not going to run across that terribly often. But then we come to one of the most common codes of them all, which is the normal distribution. Now the whole point about a pension plan or an IRA is to save for your retirement. You're creating an account, you're putting investment into it, and you're waiting until you reach retirement age. And when you retire, then you can begin to take your regular distributions. And so theoretically, if the purpose of the account is to save for retirement, eventually you will retire and eventually you will begin to take those normal distributions. And so box 7 is exactly that. It's a normal distribution and there is taxable income in most cases, but there is no penalty. Typically you're only going to begin to take normal distributions after the age of 59 and a half, and we'll see a couple of exceptions to that. Then we move on to excess contributions plus earnings taxable in 2012. That would mean you put more in than you're allowed to. And then we're going to go on to some others, and I'm not going to read them all to you, but I do want to look at some of the other codes that pop out at me, including Code B, which is a designated Roth account distribution. Then we have G, which is a really common code. I see Gs all the time, and that means that there was a direct rollover and rollover contribution. It means money came from a pension plan, such as a 401k plan or an IRA, and it was directly rolled over into another plan, usually an IRA. Code H means there was a direct rollover of a designated Roth account to a Roth IRA. Code J means that there was an early distribution from a Roth IRA with no known exception to the early withdrawal penalty. Now the thing with Code J is typically it shows the total gross amount of the distribution, and a preparer who's not quite sure what they're doing could take that the entire distribution is taxable to that particular beneficiary. And in fact, a Code J simply means that there was a distribution from a Roth account, but in nearly every situation, a person who has money in a Roth account is going to have a basis in that account, which means only part of the distribution, or perhaps even none of the distribution, is actually going to be taxable, even though there is an early distribution going on. So as a practitioner, we need to be thinking about the rules and making a determination whether or not that distribution is taxable, what portion of it is taxable, and whether or not a penalty applies. Code L, I don't see this code terribly often, but it's an important code, and it's an easy code to remember. L stands for loan. And if you have a 1099-R with a code L in box 7, it means that your client borrowed money from their pension plan. And as long as they're making payments on that pension plan, everything's great. They don't report income on the return. But if they default on that loan, or if they terminate employment with the employer that supports that pension plan, then any of the money that remains unpaid is going to be treated as a distribution. And it's also a distribution that's subject to the early withdrawal penalty, 10% penalty. So Code L typically means that a loan was either defaulted on or a loan had not been defaulted on, but the period of employment ended, and therefore any outstanding loans with that particular pension plan are now treated as distributions subject to the penalty. Code N, recharacterized IRA contribution. Code P, excess contributions plus earnings. Code Q, qualified distribution from a Roth IRA. Code R, a recharacterized IRA contribution. Code S, this is an important one, fairly rare, but still very important. Code S means that there was an early distribution from a simple IRA in the first 2 years. And if that's you, then you owe a 25% penalty rather than the normal 10. Code T, you use code T for a distribution from a Roth IRA if you do not know if the 5-year holding period has been met, but the participant either reached age 59.5, died, or became disabled. We then have code U, dividend distribution from an ESOP, and then finally code W, charges or payments for purchasing a qualified long-term care insurance contract. Now the codes that I think you should know, if you look at a 1099-R and one of these codes appears on the 1099-R, you should like that know what they mean. They include code 1. Code 1 means early distribution, no known exception to the penalty. Code 2 means early distribution, but an exception to the penalty applies. Code 4 means that this was a death benefit, there is no penalty, and code 7 means that this is a normal distribution with no penalty. Also, if the IRA SEP simple box is checked, there are special rules that apply to the distribution, since IRAs, SEPs, and simple plans can have different rules than pension plans do. Moving on with the 1099-R, the last box I wanted to point out to you is the total employee contributions box. The plan administrator is not required to enter the total employee contributions, but they may choose to do so. And then, of course, we have the state withholdings box. I find that very often there is no state withholding in 1099-Rs. Particularly the case if an employee works for a particular employer, that employer is set up, say, in California, and then the employee retires to Oregon, that the California employer will not make payments to Oregon. So it's very common for the state withholding boxes to be empty, and sometimes even despite numerous requests, the people administrating those plans refuse to do state withholding. But speaking of withholding, it is necessary in most cases for people to have withholdings on their pension plan distributions, and sometimes, actually quite frequently, I establish while working with clients that they are under withholding either on their pension, their Social Security, or as a result of other incomes they have where there is no withholding going on at all. And so one of the things I do with my clients is analyze their tax return as I'm working on it and establish whether or not they're under withholding. And if they are, one of the things I do fairly frequently, several times every tax season, is assist my clients with preparing Form W-4P. Form W-4P is used to tell the plan administrator how much tax withholding you want, and it works very similarly to the W-4 form that you would fill out and give to an employer. And on the form you indicate the number of exemptions that you are claiming, whether your marital status is single, married, or married withhold at the higher single rate. And of course, married withholds far less money than single does, and so if your client is not withholding enough, odds are that married is probably not the box you should check. In most cases, people who are trying to get more withholding going on should check single or married but withhold at the higher single rate. But if your client is fairly close to break even and just needs to have a little bit of withholding going on, then, and they are married, then of course married could be the box you check. Now, we're also going to look at some other definitions you should probably be familiar with. Some of them are rather elementary. Others may be terms that you've heard but you're not quite sure what they mean. All of the definitions I'm about to give you on this page in the manual come from IRS Publication 575. If you were to go to other sources and look up definitions, you might come up with slightly different definitions, but since this is a tax law course, I decided that the IRS's definitions are the ones we should look at. IRS says that a pension is generally a series of definitively determinable payments made to you after you retire from work. Pension payments are regularly made and are based on such factors as years of service and prior compensation. I find very often when I talk to clients and I use the word pension that it's not necessarily a word that they use that often. They might refer to their 403B plan, their 401K plan. Here in Oregon, public employees receive retirement income from something called PERS, which is the Public Employees Retirement System. And so I sometimes find when I talk with clients and I use the word pension, they're confused by that. But pension is just really a broad term used to describe employee or retirement accounts. An annuity is a series of payments that are under a contract made at regular intervals over a period of more than 1 year, and they can be either fixed or variable, and you can buy the contract or loan as an individual, or you can buy it with the help of your employer. A qualified employee plan is essentially what I personally think of a pension plan as. It's just another word for pension plan if you ask me, but IRS does go out of its way to define it separately. A qualified employee plan is an employer's stock bonus, pension, or profit sharing plan that is for the exclusive benefit of employees or their beneficiaries and that meets certain Internal Revenue Code requirements. It qualifies for special tax benefits such as tax deferral or employer contributions, and capital gain treatment is available in certain situations for that select group of people born before 1936, that is. Now, one of the things I thought I should point out about this particular term here, qualified employee plan, is that this is qualified under Internal Revenue Code laws, and that means that you could have a plan that is in fact a pension plan that is not a qualified employee plan. And the most common one that I run across is actually clients who have pension plans in foreign countries. Maybe they worked for Nike when they were in Germany, and so they have a pension plan set up with Nike in Germany. And so that would not be a qualified plan, even though it is a pension plan. I have another client who has a Swedish pension. So it is a pension plan, but it's not a qualified plan. And that would be the difference between the two. Then we have a qualified employee annuity, which is a retirement annuity purchased by an employer for an employee under a plan that, again, meets Internal Revenue Code requirements. And then we have something called a designated Roth account. A designated Roth account is not a Roth IRA. It's a relatively new form of retirement account that allows you to make contributions to a Roth type account through your employer plan. And so, in other words, you're making contributions to a plan through your work, but you don't get to deduct the amount of money that you're putting into the plan like you would with a 401k plan. So it's not a salary reduction plan, but it is a tax benefit plan in that the money you put in there is allowed to grow tax-free. Tax-sheltered annuity plan. A tax-sheltered annuity plan is often referred to as a 403B plan or a tax-deferred annuity. It is a retirement plan for employees of public schools and certain tax-exempt organizations. Generally, a tax-sheltered annuity plan provides retirement benefits by purchasing annuity contracts for its participants. Here are the different types of pensions and annuities. We have fixed period annuities. We have annuities for a single life. And an annuity for a single life means that the annuity will last for the length of the plan owner, but payments end at that owner's death. And then we have joint and survivor annuities, where when the first annuitant receives a definite amount of money at regular intervals over time, and when that person passes on, their beneficiary or their survivor will be able to continue receiving benefits. And then we also have disability pensions. You receive disability payments because you retired on disability and have not reached minimum retirement age. So those are all pension and annuity definitions. We'll go now and take a look at IRA definitions. They're a little bit different, and they of course come from publication 590, which focuses on IRAs, as opposed to 575, which focuses on pensions. And actually, just while I'm on that thought, going back to the front cover of the manual, you can see I did give you a reading assignment. And when you are trying to research something that is confusing you as a tax practitioner, it is helpful to know where to go to find the answer. Even after 20 years in this business, I regularly consult the IRS website every tax season to research stuff I'm not clear about. Maybe I think I understand it, but I'm not quite sure, or I've hit some bump that is causing me concern about my own confidence in my knowledge base. And so I go to the IRS website to find a publication, and it helps to know where to go. Today, you can always refer to Pub 17 for a general piece of information, and part of today's course is being pulled from Pub 17. But the focused publications include Publication 575, where you can read about pension and annuity income and IRS treatment of those income types. And then finally, Publication 590, which focuses on IRAs. And if you can't find the answer to your question in those publications, you can always read the instructions for Forms 1099-R, 5329, 5498, and 8606. Sometimes instructions for the forms are not covered at all inside the publications and vice versa. More often I see some complementary information where if you're, for example, filling out an 8606, you're not quite sure about how to make an entry on a particular line. The form is going to give you instructions for that, but it might refer to the publication, or the publication might refer to the form instructions. So certainly it doesn't hurt to have all of that information in front of you when you're tackling something new. So going back now onto the IRA definitions from Publication 590, we'll start with individual retirement account. An individual retirement account, or IRA, is a trust or custodial account set up in the United States for the exclusive benefit of you or your beneficiaries. The account is created by a written document, and the document must show that the account meets all of the following requirements. Number one, that the trustee or custodian must be a bank, a federally insured credit union, a savings and loan association, or an entity approved by the IRS to act as a trustee or custodian. Now, I often have clients ask me, yeah, I'd like to open up an IRA, where do I go? And my answer is, well, where do you bank? Because that's probably the simplest place. If they're in a hurry to open up an IRA, it's April 10th, and I've told them, well, you can save some money if you transfer money from your savings account into an IRA. You can take a deduction for that. So they're kind of on short notice trying to figure out where and how they might do that, and typically the easiest place to send them is the place they're already doing their banking. But you may have associations with financial advisors who are hoping you will send them some business, which may be an option that you want to take advantage of. But on the short term, just the knowledge that pretty much any bank in existence can open up an IRA makes it easy to send people to a place where they can do that. Also, other rules that apply to IRAs. The trustee or custodian generally cannot accept contributions of more than the deductible amount for the year. However, rollover contributions and employer contributions to a simplified employee pension plan can be more than this amount. Contributions except for the rollover contributions must be in cash. You must have a non-forfeitable right to the amount at all times. That means the money in the account is yours, and anytime you want to pull it out, you're able to. That's one of the rules. Money in your account cannot be used to buy a life insurance policy. Assets in your account cannot be combined with other property except in a common trust fund or a common investment fund. And you must start receiving distributions by April 1st of the year following the year in which you reach age 70.5. So those are the common rules that essentially apply to all IRAs with some exceptions. And now we're going to look at the different types of IRAs, and the first one in the list here is the Roth IRA. A Roth IRA is an individual retirement plan that generally is subject to rules that apply to the traditional IRA, but not all of the rules. It can either be an account or an annuity, and to be a Roth IRA, the account or annuity must be designated as a Roth IRA when it is opened. You don't just turn a regular IRA into a Roth IRA. You have to go and open up a Roth IRA to begin with. A deemed IRA can be an IRA, but neither a SEP IRA or a simple IRA can be designated as a Roth IRA. Now, unlike a traditional IRA, you cannot deduct contributions to a Roth IRA. But if you satisfy the requirements, qualified distributions are tax-free. Contributions can be made to your Roth IRA after you reach age 70.5, and you can leave amounts in your Roth IRA as long as you live. So there's a couple of good benefits going on there with Roth IRAs. You can make contributions regardless of your age, and there's no age at which you are required to take distributions. A traditional IRA is the original IRA. When I first got into taxes, traditional IRAs were the main IRA that people had. There was, of course, the concept of simple IRA or simplified employee pension plan, but those are typically opened by small business owners for themselves and their employees. And if you're just looking at an individual who wanted to open up an IRA for themselves, traditional IRA is the one that we commonly think of. And a traditional IRA is any IRA that is not a Roth IRA or simple IRA. A simple IRA is a plan that provides small employers with a simplified method to contribute towards their employees and their own retirement savings. Employees can choose to make salary reduction contributions, and the employer is required to make either matching or non-elective contributions. Contributions are made to an individual retirement account that is set up for each employee. And then we have this other concept here, which is the Simplified Employee Pension Plan, or SEP. The SEP plan allows employers to contribute to traditional IRAs that they set up for their employees, and a business of any size, even a self-employed person, can establish a SEP. Now, today's class is not about putting money into pension plans. Rather, today's class is what happens when you take money out of pension plans. So we're not going to be going into really any detail at all about how to open these accounts and make contributions to them. Rather, the option of opening an account and making a contribution to it, at least on the individual tax return, that's an adjustment item. And so if you're interested in how these adjustments happen and how they're calculated on an individual return, we actually cover that in a couple of weeks in a course that we have called Adjustments to Income. So our Adjustments to Income course will focus a lot on IRAs, how you make contributions, whether or not you're allowed to claim a deduction for money you put into that IRA, how much you're allowed to put in the IRA, and so forth. But today's class is really about the opposite and what happens when you take money out. And with that, we're going to move on to this concept, which is determining the taxable portion of a distribution when you do take money out. Your distribution from your retirement plan may be fully or partially taxable. To be partially taxable, you must have after-tax contributions that have been put into the plan or the annuity. Your after-tax contributions are considered to be your cost in the plan. Your distribution from your retirement plan will be fully taxable if either of the following is true. You made only pre-tax contributions, or your employer paid all of the cost of the contributions for you. So if we go back up to page 2 of the manual and look at this W-2 where we show a contribution being made for Buck Rogers, we can see here that the entire contribution has been deducted from his income. That means he has zero cost in this plan. And that's the way it is for most employees, zero cost. Cost or investment in the contract. Before you can figure out how much, if any, of your pension or annuity distribution is taxable, you must first determine your cost in the plan. Your total cost includes amounts that you paid and amounts that your employer paid that were taxable to you at the time they were paid. If all of your contributions were pre-tax or were made on your behalf by your employer, then you have zero cost in the plan, and any distribution you take from it will be fully taxable. However, if you made non-deductible contributions to a retirement plan or annuity, then the payor may indicate the taxable portion of the distribution in Box 2B of the Form 1099-R. But if Box 2B is blank, you will need to figure the taxable portion of your distribution by completing the simplified method worksheet. And we're going to fill out that worksheet a little bit later today. If you made non-deductible contributions to your IRA as opposed to a pension plan, you will figure the taxable portion of a distribution from your IRA by completing Form 8606. So 2 important distinctions here. If you have a tax basis or a cost in your pension plan or annuity, you figure the taxable portion of a distribution from that annuity or pension plan by completing the simplified method worksheet. But if you have a cost in your IRA and you take a distribution from your IRA, you figure the taxable portion of the distribution from an IRA by completing Form 8606. So we're going to talk about Form 8606 next. 8606 is one of the forms that I consider to be a little bit more intimidating than the average form. It's got multiple parts, multiple pages, and if you spend long enough staring at it, you'll probably get yourself confused. So we're going to spend some time on 8606 today looking at what happens when you take a distribution from an IRA in which you have a cost. And in our upcoming class on adjustments to income, we will learn how to fill out 8606 when we make a contribution to an IRA, and how much tax basis we're going to be generating in our IRA because of that contribution, or how much of a deduction we're allowed to claim because we made a contribution. So today, or what I could tell you is 8606 is a form used for 2 purposes: to show contributions to an IRA and to show distributions from an IRA. And today we're going to be looking at what happens when you take a distribution from your IRA and how to fill out 8606 with regards to that. So moving on again, with Form 8606, if you withdrew money from a traditional IRA in which you have a cost basis, you use Form 8606 to report the amount of the distribution and to calculate the taxable portion of the distribution. If you do not have a cost basis in your IRA because all of your contributions to that IRA were fully deducted on your tax returns in the earlier years, then your distribution from your traditional IRA is fully taxable and the form is not filled out. It's not required. So Form 8606 is only used when you have a basis in your IRA, and it's only used to show what portion of a distribution from that IRA in which you have a basis is going to be taxed. So here are the situations where Form 8606 is required. Number one, you made non-deductible contributions to a traditional IRA during the year, including a repayment of a qualified reservist distribution. 2, you received distributions from a traditional SEP or simple IRA in 2012, and your basis in traditional IRAs is more than 0. For this purpose, a distribution does not include a rollover, qualified charitable distribution, or a one-time distribution to fund an HSA. Or you converted an amount from a traditional SEP or simple IRA to a Roth IRA. So if you made a conversion from a traditional SEP or simple IRA to a Roth IRA, that's a reason why Form 8606 is required, and we'll actually do an example of that today. You received a distribution from a Roth IRA in 2012 that was not a rollover, recharacterization, or other kind of contribution. Or you made a repayment of a qualified disaster recovery assistance or qualified recovery assistance distribution that is attributable to previously non-deductible contributions. Or finally, you received a distribution from an inherited Roth IRA that was not a qualified distribution, or from an inherited traditional IRA that has a basis, or you rolled over an inherited plan into a Roth IRA. So here is the Form 8606 itself. And if you didn't get a chance to print an 8606, you could just make a note of the fact that there is a blank 8606 on page 13 of the manual, because we will be having you do this form a little bit later in today's class as a classwork assignment. And here is page 2 of the form. So you can see that Form 8606 is a 2-page, 3-part form. Part 1 of the form up here is titled Non-Deductible Contributions to Traditional IRAs and Distributions from Traditional SEP and Simple IRAs. Part 2 is used to report conversions from traditional SEP or simple IRAs to Roth IRAs, and Part 3 is distributions from Roth IRAs. And here is an illustration figuring the taxable part of an IRA distribution using Form 8606. George Jetson, born in 1950, is retired, and during the year his income included $15,000 of Social Security benefits and distributions from his pension plan and his traditional IRA. George's basis in his traditional IRA for 2011 and earlier years was $40,000, and his IRA at the end of the year had a value of $200,000. His 1099-Rs and his Form 5498 are attached. So let's take a look at this 5498, because I told you that most of the time there's not much reported on this form, and this is really a good example of what the form usually looks like when I see it. You'll see it has the name of the trustee, the EIN of the trustee, the Social Security number of the plan participant, and the personal information of the plan participant. And then all of the boxes are blank except box 5, which shows the fair market value of the plan at the end of the year, and the type of plan it was. And in George Jetson's case, it is a traditional IRA. So there's an important number here in box 5. I need the number that shows in box 5 to fill out the 8606 for George Jetson. So let's just remember that that box says $200,000. We then go over to the 1099-R for George Jetson, and you can see that there was a gross distribution of $12,000. The taxable amount not determined box is checked, so the plan administrator doesn't know whether any or all of the distribution is taxable, and the fact that the box is blank does not mean that none of it's taxable. It then shows a distribution code of 7, which means it's a normal distribution, not subject to the penalty. And then we see that the IRA, SEP, or simple box is checked, and that means that this income will get reported on line 15 of the 1040 rather than line 16 of the 1040. And then we move on to the next 1099-R, which says AAA Retirement Fund, and you will notice that the IRA box is not checked, which means that this is a distribution from a pension or annuity. The income will be reported on line 16, and here we're showing you that the gross distribution and the taxable amount are both the same, $42,000, and that's the treatment that we will give them. Now here is George's Form 8606, and what I've done is I've basically highlighted the various sections of the form so that you can see that the box up here in yellow is going to be describing this box in yellow. So part 1 of the form, George took a distribution from his IRA in which he has a basis, and he's going to use the Form 8606 to figure his taxable distribution. On line 1, we enter 0, and the reason we enter 0 is that George made no contributions to the plan. He only took distributions from the plan. And then on line 2, it asks for his total basis in his IRA. Well, how do we know what his basis is? Well, I told you his basis is $40,000 in the wording of the problem, but the reality is that if you have a client who has a traditional IRA in which they have a basis, it's their job to track their basis. Now, when you complete Form 8606 because you made a non-deductible contribution to an IRA, you've used Form 8606 to tell the IRS what your basis in that account is. So assuming Form 8606 was properly and correctly submitted each and every year to the IRS, and your client kept copies of the tax returns that they prepared, you could look to the most recent Form 8606 previously filed in an earlier year to establish what their basis in that plan is. That is, if the reform has been properly done by the tax preparer or by the client because they knew enough to do that, and that's the big question mark. The dilemma, of course, with basis is that IRS says if you can't show how you calculated your basis, they're pretty much going to work off the assumption that you don't have one. So again, good record keeping is very crucial. Moving on to the green box, we start at line 6. And we've entered $200,000 because line 6 says enter the value of all of your traditional SEP and simple IRAs as of December 31, 2012. Well, that was what was shown to us on the 5498 form. It showed that the year-end value of the account was $200,000, and so that's the amount we enter on line 6. And then on line 7 it says what was the distributions you took from the account during the year, and the 1099-R shows us that the distributions from the IRA were $12,000. The math or the formula on the form then is to take the year-end balance and add to that distributions claimed during the year or taken during the year, add those numbers together, and when you do that you get $212,000. And then on line 10 it says divide line 5, which is the basis in the plan, by line 9, which is $212,000. So if you take line 5 divided by 212, you get 18.87%, or decimal 1187. Essentially what that means is that 18.87% of the IRA distribution that George took for the year is taxable. And so the very next step is to multiply line 10 by line 7. And when you do that, you get $2,264. That is the amount of the distribution that George does not have to pay tax on because it is a return of his basis. We then take the total amount that was returned to him tax-free and subtract that from the opening basis for the end of 2011. And when we do that, we get $37,736, and this is essentially his year-end basis for 2012, and it will carry forward to 2013. And what we're left with on line 15 is the amount that he has to pay tax on. $2,264 from 12 is the taxable portion of the distribution, $9,736. So let's move over to George's 1040 form now. And we will see that we did a lot of work on 8606 to come up with this number for line 15B. Line 15B shows that the taxable distribution is $9,736. The gross distribution was $12,000. And then we move over to line 16, and if you recall, George also had a distribution from his pension plan. The amount of the distribution was $42,000. All of it is taxable. And so line 16B has the full $42,000 entered on it. It's been my observation that tax software leaves line 16A blank if the distribution amount and the taxable amount are the same number. And so the software we have has left this box blank. But there'd be no harm in having $42,000 in both boxes. It's just that tax software typically doesn't put a number in box 16A if box 16A and B are the same. But you can see that line 15A is a higher number than line 15B, and therefore both numbers are entered. The next topic of the day is rollovers. And if you withdraw cash or other assets from your qualified pension plan or IRA, you can defer tax on the distribution by rolling the funds over into another qualified plan or IRA. You have 60 days to roll the taxable portion of your distribution into a qualified plan or IRA, and you can choose the direct rollover option by having your administrator from the one plan directly send the money to the other plan, or you can just take a distribution from the plan, walk down the street, go into the offices of where you want to open up the new plan, give them the check, and make the deposit. The problem with that second method is typically the plan administrator of the first plan is required to hold out 20% tax. And so if you've had 20% tax withheld and you walk over to open up the new account, well, you have less money to do it with. So rollover options are the simplest way to do a rollover. We're going to have a next topic coming up, which is the rollover to Roth IRAs or Roth conversions. And since we're approaching the top of the hour, this is probably a good point to take a 10-minute break. And at the end of the 10-minute break, we will return and pick up on this topic. Password number 1 is Picard. P-I-C-A-R-D. Picard. So as we were heading into break, we said that you can make a rollover. You can convert amounts from either a traditional SEP or simple IRA to a Roth IRA, and these conversions are treated as a rollover regardless of the conversion method that is used. You may also roll over eligible distributions from qualified retirement plans to a Roth IRA. Now, if you remember the old rules, you may remember that the only time you can roll money from a retirement account into a Roth IRA is if you roll over from a traditional IRA, but that rule was changed in 2007. So for tax years after 2007, you're no longer restricted, and it is possible to do a rollover conversion from any kind of retirement plan to a Roth account, including qualified pensions, profit sharing or stock bonus plans, 401k plans, annuities, tax-sheltered annuity plans under 403b, and deferred compensation plans of a state or local government. The rollover is subject to the same rules that apply for converting a traditional IRA to a Roth IRA, and beginning in 2010, another important rule changed. That rule is that the modified AGI and filing status requirements that were in place have basically expired or have gone away, and it is now possible to make a rollover from a retirement account, including a traditional IRA, to a Roth IRA, regardless of your filing status and regardless of your income amount. So for 2009 and earlier years, if your modified adjusted gross income was more than $100,000, or you had a filing status of married filing separate, it was not possible to roll money into a Roth IRA, but that rule is now gone and you have no income restrictions at all. The concept of removing restrictions on the rollover, but not also removing the restrictions on the direct contributions, puzzles me. And what I mean by that is, although it's now possible to do a rollover from one retirement account to a Roth IRA, regardless of your filing status and income type, there still are restrictions on direct contributions to Roth IRAs, in that if you are above a certain income amount, you cannot make a direct contribution. But of course, anyone with a little bit of common sense can figure out that if your income is too high to allow for a direct contribution to a Roth account, all you need to do is contribute the money to a traditional IRA account, which has no income restriction on it, for upper income that is, and then do a conversion from the traditional IRA into the Roth account and essentially bypass that income restriction. So why they haven't removed the income restriction on direct contributions, I don't know, but they haven't, and that's the simple workaround for it. Now, a rollover into a Roth IRA is generally not tax-free. You do need to report the rollover distribution on your 1040 return as income. If the rollover was from an IRA, enter the rollover distribution amount on Form 1040 line 15A, and if you have a tax basis in your traditional IRA, you will need to complete Form 8606 to figure the taxable portion of the rollover. You then enter the taxable portion of the rollover on line 15B, and if you recall, we just did that with George Judson. Not for a Roth conversion, but just to figure the taxable portion. Now, if George had, instead of taking a distribution from his traditional IRA, had just decided to do a rollover conversion to a Roth IRA, his tax return really wouldn't have looked a whole lot different. We would have made some more entries on the 8606 to show that there was a conversion rather than a full distribution, but the tax ramifications on his 1040 would have been identical. In other words, the amount of tax he had to pay would have been the same. If the rollover was from a pension plan or annuity plan, you will enter the total distribution received from your qualified pension plan that was then rolled over into a Roth IRA on line 16A and 16B. And generally, of course, the rollover from a pension plan to a Roth account will be fully taxable unless you can show that you have a basis in that pension plan, which normally is not the case. We have something new here called an in-plan direct rollover, where you take money from a 401k or a 403b and roll it into something called a designated Roth account. A designated Roth account is not the same as a Roth IRA. A Roth IRA is a form of IRA, but a designated Roth account is not a form of IRA. It's a form of retirement account, and it is similar to a Roth account in that the money you put into it is not deductible, and presumably when you start to take qualified distributions, those distributions will be tax-free. The main difference between an in-plan rollover and a Roth conversion is that an in-plan rollover cannot be undone. So if you have a 401k plan and your employer comes up with this in-plan Roth and says, hey, you can do an in-plan conversion to a Roth, and you think that sounds like a good idea, so you do it, and then later on, a few months later, you decide that was a bad idea, you can't undo it. And that's very different than a Roth conversion, where if you convert money into a Roth IRA from a pension plan or another IRA, and you have second thoughts about it, it is possible to undo that move. 2010 in-plan conversions. For 2010 rollovers only, the taxable amount rolled over is includable in income equally for 2011 and 12, unless the taxpayer elected to include it in income for 2010. And that's going to be actually the next topic we're going to move on to, is how the rules for 2010 rollovers to Roth accounts are a little bit different than they are for other years. Now, the first thing to note is that when you do a rollover from a retirement account to a Roth account, that the early distribution does not apply. The early distribution penalty does not apply, even though the distribution itself is taxable. So typically, when you do an early distribution, Box 1 will show the gross distribution amount that is rolled over. Box 2A will show the taxable amount if the administrator or payer has the information to figure out the taxable amount. And Box 5 will show any basis the employee might have, which is usually 0. And then Box 7 will show a code G, which indicates that the plan was rolled over and not subject to withholding. However, if the rollover went from an IRA to a Roth IRA, then the rollover is taxable. And if it went from a 401k to a Roth IRA, the distribution will be taxable. So you do have to look to the type of account that the rollover went to, and if it was a rollover to a Roth, it will be taxable. Special rules for 2010 conversions and rollovers. For 2010 only, any part of a taxable distribution that was for a conversion or rollover from an IRA or an employer plan to a Roth IRA was given special treatment. The taxable portion of these distributions was includable equally in income, not in 2010, the year of the distribution or the rollover, but rather instead in 2011 and 12 equally. So if you made a taxable conversion in 2010, and quite a few people did leap at this opportunity to not pay tax in 2010 and instead chose to pay tax in 11 and 12, then no income was reported on the 2010 return. So even though we're talking about an event that happened 2 years ago, possibly 3 years ago now that we're in 2013, we could still be dealing with it today as we're preparing our client's 2012 tax return. So it was possible to elect to treat that income as income on the 2010 return. Most people, of course, took advantage of the fact that they could spread that income out equally, or the tax on that income out equally over a 2-year period, 2011 and 12 instead. And different tax treatment would apply, however, in the following situations. If you elected to include the entire rollover amount in your gross income in 2010, instead of deferring it to 2011 or 12, then that election would have been made in 2010, and you would have completed Form 8606 for 2010 and shown the total amount you're including in income on line 19 of that form. Now, if you elected to defer the taxable part of your 2010 conversion over that 2-year period for 2011 and 12, and then in 2010 or 11, you took a distribution of any amount that was allocable to the taxable part of the conversion, then you're not going to be able to defer the entire amount to the later 2 years, which was your original plan. So I came up with this illustration for our manual because I saw a number of clients doing exactly this. In 2010, they decided to do a Roth conversion. They took money from their pension plan or their traditional IRA and converted it to a Roth account in 2010, and then immediately or within a few months of that in 2010 actually took a distribution from the Roth account. Maybe they were somehow imagining that they would avoid penalties or get some better tax treatment for doing it, or maybe not have to report the income for another 2 years, but none of that was the case. And since I saw multiple occurrences of this going on, I thought it would be important to cover it in our tax school. And so 2 years ago I created this problem, and the problem still remains relevant today because it is possible today, as we're preparing 2012 returns, that we did have a client in the past couple of years that is affected by this situation. So if you elected to defer the taxable part of a 2010 conversion of the 2-year period, and then in 2010 or 11, you took a distribution of any amount that was allocable to that converted amount, then the following rules apply. Number one, the taxable part of the conversion that was actually distributed in 2010 had to be included on the 2010 return. And you had to complete Form 8606 and determine the taxable amount and enter it on the 1040 return for that year. The amount that was included on the 2010 return as income reduces the income to be reported in the following 2 years, 11 and 12. But you reduce the amount to be reported in income for 12 first, and then any amount that is taxable for 11 is reported in the 2011 return. So in other words, if in 2010 you rolled over $10,000 and then you took $5,000 out, that $5,000 that you took out is going to not be reported on the 12 return. And in 2011, you're still going to report the first $5,000 that you thought you were going to get away with deferring. So here's an illustration involving a $10,000 amount and a character named Jenny. In 2010, Jenny converted $10,000 from her traditional IRA to her Roth IRA. She had no basis in her traditional IRA, so the rollover was fully taxable to her, and she received the illustrated 1099-R. You can see we've got a code G that indicates there was a rollover conversion. Jenny decided not to report the income from the conversion on her 2010 return, and she completed Part 2 of her 2010 Form 8606 as shown here. So here is Part 2 of her 2010 8606, and you can see on it she's indicated that $10,000 is the amount that she converted. And then in Part 2 of that form from 2010 still, we show that she's made the decision that she's going to defer income to 11 and 12, and the amount that would be reported in income on our 2011 return is $5,000, and the amount to be included in income on our 2012 return is another $5,000. So she reported nothing in her income for 2010 and did that rollover. Now we're into 2011, continuing with Jenny's life, new year, new tax return. In 2011, Jenny took a distribution of $3,000 from her Roth account and received another Form 1099-R. For 2011, Jenny had to report and pay tax on 1/2 of her Roth conversion from 2010, plus the $3,000 she took out in 2011. So her initial plan up here was she'd report $5,000 in 11, $5,000 in 12, but when she got to 11, she took out 3. And IRS says, well, if you take out 3 in 2011, for 2011, you're still going to report the full 5 you were required to report, and you're also going to report an additional 3 that normally you wouldn't have had to report until 12. And so what does her tax return look like? Well, we move over to the 8606 for 2011, and on that form we show the distribution that she took. We show the amount that she was required to report because of the 2010 conversion, and we add the 3 to that 5 when we end up with 8. So on her 2010 1040, she's going to show that she took a distribution of $3,000, but the taxable amount is $8,000. And then what's going to happen for 2012? Well, on her 2012 return, she's going to report that final remaining $2,000 that still has to be included in income. Roth conversion considerations. So Roth accounts are popular with investment advisors. They like Roth accounts, always have, from the very first year that the Roth ever came out, and I remember that, it was 1998. Back in 1998, there was that first opportunity to open up a Roth account. And back in 1998, you were actually given 4 years. If you did a conversion from a traditional IRA to a Roth IRA back then, you were given 4 years to spread out that tax. And back then, there were a lot of investment advisors telling my clients to do that. And some of my clients jumped at that opportunity and were left reporting income over a 4-year period, convinced that that was a good move. But Roth conversions are not necessarily a good move for a good number of people. And I frequently run across clients who are encouraged to open up Roth IRAs by their investment advisors when I think they've really got no business opening up Roth IRAs at all. But we will talk a little bit about the type of individual who can benefit from a Roth account. So let's just theoretically look at what a Roth IRA allows you to do. A Roth IRA allows you to make a contribution to a retirement account using after-tax dollars, and money that's put in that account is allowed to grow tax-free, and if you have the account for a minimum of 5 years and you reach age 59 and a half, then all of the money you take from the account is not taxed. So it's a pretty attractive financial investment. But let's look at the restrictions on it. Firstly, when you put money into the account, you have to have the economic resources available to say, okay, if I put the money in here, I know I'm not allowed to touch it. I need to leave it there and not pull it out. Because if I do pull it out, I'm not going to get that tax-free treatment, and any income that it earned while it was in there is going to get taxed with a penalty. So I have to have that discipline and the financial resources available to leave the money in there. Secondly, why not take advantage of some of the other retirement options that are available out there where I do get a tax deduction, such as a 401k or traditional IRA? Can I get a tax deduction for putting money into those accounts? Well, it could be the case that the tax deduction you get today is less relevant to you than the tax savings you'll have in the future. But really, to determine whether or not that's best for you, you have to be able to kind of read the crystal ball and know what your future is going to look like. In the future, are you going to be in a higher tax bracket? In the future, is our federal government not going to change the rules so that distributions in the future become taxable? Our federal government is notorious for changing tax laws, and what's to stop them from, at some point in the future, deciding that Roth accounts can be taxed? So there's no guarantee that in the future things will be better off, and that taking money tax-free from a Roth account in the future is better than taking the tax deduction today. So we're going to talk a little bit about what it really does cost you to put money into a Roth. And then we'll see as a result of that there probably are some people who really do wonderfully benefit from the Roth account. And someone I can think of that would really benefit from having a Roth account is an individual who has a job that's, say, paying them $100,000 a year. They've maxed out on their 401k at work. And because they're maxed out at work, they're not able to invest any more money tax-free to a retirement account. They can open up a traditional IRA and put money in it, but because they have a pension plan at work and their income is above a certain point, they're not allowed to claim a deduction for anything they do put in a traditional IRA. So a person in that situation who has surplus income, the Roth account is an excellent opportunity. It's a much better idea than maybe just keep letting money build up in savings accounts. And you can still use your Roth to purchase stock portfolios and so forth. So for individuals in that situation, a Roth can be a great opportunity. But for many other individuals, maybe not. But let's look at the rules for Roth conversions and summarize the advantages and disadvantages, and then look at what happens when an individual maybe does a Roth conversion without thinking it through too clearly. A Roth IRA differs from other types of retirement accounts in 3 important ways. Number 1, there is no minimum age at which distributions are required, and contributions can no longer be made. Contributions to a Roth account are not tax deductible, and qualified distributions from a Roth account are tax and penalty free if the following conditions are met. Number 1, the distribution occurs after the required 5-year holding period, and one of the following applies. Either the taxpayer is age 59 and a half or older, the distribution is due to death or total disability, or the distribution is used for a qualified purchase of a first home. So what are the Roth advantages? Roth IRAs are popular with investment advisors who frequently promote them because income from Roth accounts is tax-free if the conditions are met. Traditional IRAs and employer plans and other retirement accounts, by comparison, are merely tax-deferred. So at some point when money comes out of these other types of retirement accounts, it's fully taxable. And so that can make those other retirement accounts less advantageous than a Roth. But what are the Roth disadvantages? Well, since contributions to a Roth IRA are not deductible, the amount of money a taxpayer can afford to contribute currently may be more limited than is the case for a tax-deferred retirement account. In addition, if you convert money from a tax-deferred retirement account or IRA to a Roth IRA, the conversion amount must be included in your income. Taxes you owe as a result of the conversion are not available for investment purposes, and it can take many, many years before you are able to make up for the amount of money that you lose to taxes. So here is an example, the current cost of contributing money to a Roth IRA. Assume you are contributing $5,000 to a Roth IRA, and your combined rate of federal and state taxes is 30%. Your after-tax cost of investing $5,000 is $5,000. In fact, you had to, of course, earn more than $5,000 just to have $5,000 left. So the extra money you had to pay in taxes is above and beyond the $5,000. But let's just start with $5,000 of after-tax dollars. That's the cost of investing in your IRA. Let's compare that to the cost of contributing to a traditional IRA, assuming you are allowed to claim a deduction if you do that. And if you are in a combined tax rate, federal and state, of 30%, the cost of contributing $5,000 to your traditional IRA is really only $3,500. And so that's one of the mathematical formulas I do with my clients all the time. Well, this year it looks like your refund's going to be $500, but if you were to invest $5,000 into your traditional IRA account, your refund will go to $2,000. And my clients think, well, that sounds like a good deal. I'm going to increase my refund by $2,000 if I go down to my bank account and pull $5,000 out of savings and stick it in an IRA. And then I'll have $2,000 coming back to me instead of only $500. So they like the math there, and that's a popular decision. Now here we have an example of a client who has received advice from a financial advisor to do a Roth conversion. And I'm doing this example based on a real-life client that I had, so you can see what my client was dealing with. Now the difference between Lisa, the illustration I have in front of you, and my client is that my client did the Roth conversion in 2010. And so by the time I met with him to discuss the tax ramifications of his Roth conversion, we were already into 2012 preparing his 2011 tax return, and there was nothing he could do to undo that. Because, of course, if you make a conversion, you can undo the conversion by doing a recharacterization, but you have to do with that within 6 months of the filing deadline of the return. That means that a 2010 Roth conversion had to be undone by October 15, 2011, and by the time my client came to see me in tax season of 2012, there was nothing he could do. But since we're preparing a 2012 tax return, we're going to have our Roth conversion occur in 2012 for a client named Lisa. And she is a 45-year-old engineer, and she is single. Her investment advisor convinced her to roll over $200,000 from her 401k plan to her Roth IRA during the year. And Lisa's only form of income is wages, and her 2012 W-2 shows $100,000 of taxable wages paid. Lisa has no dependents and will claim the standard deduction, prepare her tax return with and without the Roth conversion to determine the amount of tax she owes as a result of the conversion. And here we have her 1099-R. We can show that it was a full distribution. The total distribution box is checked. The plan administrator is silent on how much is taxable, but since it's from a 401k, we can assume it's all taxable. Distribution code of G. And we decided to make Lisa a resident of the state of Illinois just so you could see the impact of the state tax on her situation as well. Just randomly picked a state from the middle of the country, and Illinois was it. So here's Lisa's Form 1040 if she does not have a Roth conversion. You can see the only form of income she has is $100,000 of wage income. We go over to page 2 of her Form 1040 and we figure her tax. Her federal income tax on that wage is $18,738. This assumes no deductions other than her exemption deduction and her standard deduction. Since she had $19,265 withheld, she actually comes out with a $527 refund in her situation. And then over on Illinois, we decided to give her $5,200 of Illinois income tax withholding. Her Illinois tax on the $100,000 of wage income is $4,898, and she's left with a $302 refund. But Lisa did a Roth conversion, and so when she came to visit her tax preparer, she was given some pretty bad news. The bad news is that the $200,000 that she converted to her Roth is now taxable and is going to get thrown into her income, and it pushes her income up to $300,000. And the amount of tax she then has to pay on her 1040 has bumped up to $80,311, and she even has a $15 tax penalty thrown in because her withholding is not enough. So ultimately, when she files her tax return, she owes $61,061 to the IRS on this $200,000 conversion. But she's not done. We also have to move over to Illinois. And on Illinois, her tax has just increased from $4,898 up to $14,898. Her withholding is still $5,200, and so she owes the state of Illinois $9,698 with her tax return. The tax consequences of Lisa's Roth conversion. The following table shows the combined increase in her federal and Illinois tax as a result of the conversion, and we can see that with only the wage income, her federal tax was $18,738, but after the Roth conversion, it was $80,311, an increase of $61,573. Her Illinois tax, interestingly, went up by exactly $100,000, and the total additional tax she has to pay combined to Illinois and IRS is $71,573. Now, if it happens to be the case that Lisa just happened to have $100,000 sitting around a savings account with nothing better to do with it than pay taxes on it, then maybe she would think that was a good deal. But I look instead at how many years it's going to take her to recover this tax. In other words, if she left the money, the $200,000 in her pension account, and just let it sit there, she'd have $200,000 earning income for her at whatever rates her investments are paying off to her. Now that she's done the conversion and after she's paid all of those taxes, she has $71,000 that's not invested in other places and is not working for her to earn her money. So yes, in the future, when she does take money from her Roth account, that money will not be taxed, and any income it earned from the time of the conversion forward will also not be taxed. But how much of a benefit is she really going to get? And that's the question mark. Now, I am not a financial advisor, and I'm also not a mathematician. I don't sit down and work out the formulas to figure out how many years at what rate of growth it will take for her to reach that tipping point where the Roth conversion makes financial sense. What I do know is that in the short term, it's not doing anything for her, and unless she's got many, many working years ahead of her, it is entirely possible she will never recover the total tax she pays. Now, of course, we also have to look at the retirement years and what they're going to look like for her. When Lisa retires, is she expecting her income to be dramatically higher than it is in her working years? Because most people in their retirement years aren't earning more than their working years. Usually income drops. So if Lisa is in a 25% bracket today, will she be in a 25% bracket when she retires? Maybe she'll be in a lower bracket. Or maybe Lisa's earning more money today. Certainly with that Roth conversion, she's going to be pushed into a higher bracket than 25%. That Roth conversion is actually getting taxed at more than 25%. And what rate will she be at federally when she does retire? At the state level, you have to look at what kind of state taxes Lisa will be paying when she retires. If Lisa decides to retire to a state that doesn't have state income tax, like Texas, Florida, Washington State, it could be the case that she wouldn't be paying state taxes on retirement anyway when she starts taking distribution. But here in the now, when she does the conversion, she is paying state tax. So those are all things that do need to be considered in whether or not Lisa is making a smart financial decision with that conversion. So bottom line, my clients usually don't ask me these questions before they make their financial decisions. Usually I learn about them after it's too late to fix them, but it's still a fair discussion if your client does ask you the question, should I do this? There's a lot of information to bring into play in giving them a truthful answer. Now, I do see that it says, can you roll over a required distribution to a Roth account? That's a good question. The question being, can I do a Roth conversion when I'm forced to take a required minimum distribution? And the answer is no. Your annual required minimum distribution from your traditional IRA may not be rolled over or converted to a Roth IRA. However, if you meet the Roth IRA conversion eligibility requirements, you may convert the remaining portion of your traditional IRA assets to a Roth IRA, and the converted assets would be subject to ordinary income taxes in the year of the conversion. Your account will no longer be subject to the RMD rules for the remainder of your lifetime, and your assets could continue to grow on a tax-free basis. Recharacterization. Well, remember when I told you at the start of my little spiel there that my client came to see me in 2012 when it was too late to recharacterize his Roth account? Because believe me, when he found out that he owed over $30,000 for 2011 and then he owed another 30-something thousand for 2012, he wasn't happy about that. And my client actually was a medical doctor. His W-2 wasn't only $100,000 a year. His W-2 was $300,000 for the year. For both 2011 and 2012, he's got a W-2 for over $300,000. And then because he elected to spread the 2010 Roth conversion to 11 and 12 equally, in each of those years I was telling him he had to cough up over $30,000. So he wasn't happy about it, and it was too late. He couldn't do a recharacterization. But in Lisa's case, maybe I get to the point where I'm telling her she owes $70,000 more as a result of the conversion than if she hadn't done the conversion. And Lisa says, I can't afford that. I had absolutely no understanding that that was the kind of money I would have to come up with. I just had no clue. Can I undo it? And the answer is yes. There is a way to undo it, and it's called a recharacterization. In certain situations, you may determine that the amount of money you contributed to your Roth IRA should be transferred back to a traditional IRA account. And you may want to recharacterize your Roth conversion or your contribution because you determine your income is above the maximum amount allowed for an actual Roth contribution. Or after you converted money to your Roth account, the value of the account has dropped and you do not want to pay tax on the original higher amount that was converted. Or you discover that the tax liability that results from the conversion is too high, and recharacterization will prevent you from being required to include the recharacterized amount in your income. You can choose to recharacterize a Roth or a Roth conversion subject to the following recharacterization rules. This is a very simplified version of the recharacterization rules. There's more to it than that, but this is the basics. The amount of money that you recharacterized must be transferred from the Roth account to a traditional IRA, or in certain cases a SEP or simple IRA, in a trustee-to-trustee transfer, and the election to recharacterize must be made within 6 months of the due date of the return, which is October 15 for most filers. But this recharacterization date limit applies regardless of whether an extension of time to file was actually made. So many times if you don't file an extension, you're out of luck, you don't get extra time, but in the case of a Roth recharacterization, whether you file the extension or not, you do get the extra time. And the next topic we're talking about with IRAs is inherited IRAs. If you inherit a traditional IRA, you are called a beneficiary, and rules relating to the inherited IRAs differ depending on whether you inherited the IRA from your spouse or from someone other than your spouse, such as a parent, sibling, or uncle. Now, if you inherited the IRA from your spouse, you generally have the following 3 choices. You can treat the IRA as your own IRA by designating yourself as the account owner, or you can choose to treat it as your own by rolling it into your own IRA to the extent it's taxable into another type of account, such as a qualified plan, or you can treat yourself as the beneficiary rather than treating the IRA as your own. And if you treat the account as if you are a beneficiary rather than a spouse, then the rules for beneficiaries apply. You will be considered to have chosen to treat the IRA as your own IRA if contributions, including rollover contributions, are made to the inherited IRA, or you do not take the required minimum distribution for a year as a beneficiary of the IRA. You will only be considered to have chosen to treat the IRA as your own IRA if you are the sole beneficiary of the IRA and you have unlimited right to withdraw amounts from it. However, if you receive a distribution from your deceased spouse's IRA, you can roll that distribution over into your own IRA within that 60-day limit as long as the distribution is not a required distribution. And this is even if you are not the sole beneficiary of your deceased spouse's IRA. Now, if you inherit the IRA from someone other than your spouse, you cannot treat the inherited IRA as your own, and this means you cannot make any contributions to your inherited IRA, nor can you roll over any amounts into or out of that inherited IRA with respect to other IRA accounts that you have. However, you can make a trustee-to-trustee transfer from the inherited IRA to another IRA which you set up as the inherited IRA. So if you start with one financial institution and you decide, hey, I don't like that, maybe it's the financial institution that the IRA was housed with when you inherit it, and you decide you want to move that IRA to another financial institution, you can do that so long as the account retains its character. In other words, it was an inherited IRA, you're rolling over, it's still an inherited IRA, it's in the name of the decedent with you listed as beneficiary. Now, like the owner, you will generally not owe tax on the assets in the IRA until you receive distributions from it, but you must begin receiving distributions from the IRA under the rules for distributions that apply to beneficiaries, and we'll talk about that a little bit later when we get to required minimum distributions. IRAs with basis. If you inherit a traditional IRA from a person who has a basis in the IRA because of non-deductible contributions, that basis remains with the IRA and the following rules apply. Number one, you cannot combine this basis with any basis that you have in your own traditional IRAs or the basis in traditional IRAs that you have inherited from other decedents. There's one exception to that, and that is if you are the decedent spouse and you choose to treat that IRA as your own. Also, if you take distributions from both an inherited IRA and your own IRA in the same year, and each of these IRAs has a basis, you will need to complete separate 8606s, one for the inherited IRA, one for your own IRA, because the basis and the calculations of how much is taxable when you take distributions from an inherited IRA and your own IRA will be calculated separately. Rather, the opposite of when you are an individual and you have basis in a traditional IRA that you've set up and you have another IRA in your own name, if you take distribution from either of those IRAs, you have to combine the basis in both on the same 8606. But when you have your own IRA and then you have an inherited beneficiary IRA, you never combine those two IRAs. And then loans from pension plans is something we touched on a little bit ago. So loans from pension plans, distribution code of L. I used to see a lot of these, but I don't see so many anymore. It just might be that my client base has changed and there's no change in the commonality of it. But I haven't seen a distribution code L personally in a number of years, but there was a period of time where I saw them quite regularly. So you may be able to borrow money from your qualified pension plan or annuity, tax-sheltered annuity, program, government plan, or a contract purchased under any of these plans for the purchase of a main home or a first home. If you close out of the plan prior to paying back the loan, or if you default on paying back the loan shall be considered a distribution. And you may have to include in income all or part of the amount borrowed unless certain exceptions apply. And then, of course, if you do have to include it in your income, then the early distribution penalty typically does apply. And speaking of early distribution penalty, it is referred to as an additional tax, and that's the next topic of the day. Pension plans and IRAs are given special tax treatment to encourage people to save for their retirement. And penalties exist in the form of additional taxes if the funds within the plan are withdrawn early, which is referred to as an early distribution, or the minimum required amount is not distributed. That is, you did not receive the minimum distribution that is required. So what are the taxes on early distributions? Well, the tax on early distributions is commonly referred to as the early withdrawal penalty. You will generally be required to pay an additional 10% tax on your early withdrawal from your qualified retirement plan, IRA, or annuity if you withdraw the money before you reach age 59 and a half. And the tax applies to the taxable part of the distribution. There is a 25% additional tax that applies if you withdrew the money from a simple IRA if the simple IRA is opened and within 2 years of first participating in that plan, you take a distribution. So the 25% penalty does not apply to any distribution from a simple plan. It applies only to early distributions that occur within the 2 years of when you first open that plan. And then finally, there is an additional 5% tax on early distributions from deferred annuity contracts. Well, how do you report an early distribution penalty from an IRA or an annuity? Well, you report the distribution on your 1040 as you normally would, and here we have a page 1 of the 1040. The bar for line 16 means that you had a distribution from a pension plan. The line for line 15 means you had a distribution from an IRA. And when you take an early distribution, you report it as you normally would on the appropriate lines of your tax return. But if you are under age 59 and a half at the time of the distribution, you will be required to pay that 10% tax unless you qualify for one of the exceptions that we're discussing here in a minute. And you report that early distribution penalty or the additional tax on line 58. So if you are subject to the penalty, you figure the penalty and you enter it on line 58. In certain situations, you may discover that you don't have to pay the penalty, or as a tax practitioner, you interview your client and you establish that your client doesn't owe the penalty, and in which case you would fill out Form 5329 to claim an exception to the penalty. And you can see here line 58 says, attach Form 5329 if it is required. Well, 5329 is only required if you are claiming an exception to the penalty in most cases, but there can be some other situations where you use the form. But the main reason that I fill the form out is my client has an early distribution. They're going to be subject to the penalty unless I tell the IRS that they qualify for an exception. So that's what we're going to talk about now, is what those exceptions are. Exceptions to the early distribution tax for IRAs and pensions. Now, you'll see here I've underlined IRAs and pensions because any of the exceptions that you see me highlighting from this bottom arrow here to this top arrow here, those exceptions can apply whether or not the distribution comes from an IRA or a pension. But underneath that, what will come up next is additional exceptions that apply only if the distribution comes from an IRA, and they don't apply to pension plans. So let's look first at the exceptions that apply to both IRAs and pensions. And these exceptions can include payments that are made as part of a series of substantially equal periodic payments that are made at least once per year for your life or life expectancy over the joint lives or joint life expectancies of you and your beneficiary. If the qualified plan is not an IRA, you must have separated from servicing your employer. So it could be that you've reached a particular retirement age, but you're not yet age 59 and a half. And you have retired and you are now beginning to take those regular periodic distributions. And because you're taking regular periodic distributions and not just going in there and randomly pulling money out because you're short on cash, that would be an exception to the penalty. Or the payment has been made because you became totally and permanently disabled. So you took the money out of the account, but you don't have to pay the penalty, and the reason you took the money out of the account is because you became disabled. That's an exception to the penalty. The payments were made to a beneficiary on or after the death of the plan participant or contract holder. Well, if you remember back earlier in class today, we talked about the distribution code 4 appearing in box 7 of the 1099-R, and that a code 4 means that it was a death benefit, and that if it is a death benefit, there is no penalty. Well, you would need to attach a 5329 to the return if it was in fact a death benefit, but it had a code 1 in box 7 rather than a code 4. That would be a reason to attach the 5329. Payments made from a qualified retirement plan other than an IRA after you separated from service in or after the year you reached age 55, but if you are a qualified public safety officer, you only need to be age 50 for that one to apply. Payments made from a qualified retirement plan other than an IRA to an alternate payee under a qualified domestic relations order. Payments made from a qualified retirement plan to the extent you have medical expenses in excess of 7.5% of your adjusted gross income. So in this example here, essentially you've got a lot of medical expenses, so much in medical expenses that you're able to, you could be able to itemize them on your tax return because they're more than 7.5% of your income. Well, you won't have to pay a penalty to the extent that the medical expenses exceed 7.5% of your income. And on this other one up here, you're essentially in a divorce situation. You're divorcing, you've got a couple $100,000 in your pension plan, and your wife's getting half. And because you've been ordered under that divorce agreement to cash out the retirement plan and give half to your spouse, the penalty won't apply in that situation. Or payments made from an employee stock ownership plan for dividends on employer securities held by the plan. Or payments made from a qualified retirement plan due to an IRS levy of the plan. So let's just suppose you owe a whole bunch of IRS-backed taxes and you don't have the money in the bank, and the IRS has essentially levied you and ordered you to cash out your plan, or the IRS even has levied the plan and gotten into it somehow. Not sure how all of that goes on. But at any rate, you've cashed out your retirement account to pay taxes due to an IRS levy. In that case, they're being very generous. They won't take any more in the form of a 10% penalty on you. But of course, the distribution would probably still be taxable. And then finally, qualified distributions to reservists while serving on active duty for at least 180 days are also not subject to the penalty. Additional exceptions to the early distribution tax that are for IRAs only. And what's interesting about these exceptions to the penalties are that these are the most common reasons I see clients qualify for an exception to the penalty. And so I'm always desperately hoping that when my client does an early distribution that they did it from an IRA and not a regular 401k plan, because if they qualify for an exception, it's bound to be one of these three. Firstly, to the extent of medical insurance premiums you paid while you were unemployed, and certainly in our Great Recession that we're just now scraping our way out of, we had a lot of clients who were unemployed, and because they were unemployed, the only way they could afford health insurance was perhaps to cash out money from their IRA or their 401k. And the deal is if they took it from their IRA and used the distribution from the IRA to pay for health insurance while they were unemployed, that is an exception to the penalty. Or to the extent of your higher education expenses that you paid through cash loans for yourself, your spouse, your children, or your grandchildren. So if you took money out of your IRA and you used the money to pay for qualified higher education expenses, then you don't owe a penalty to the extent that the money was spent on qualified higher education, but only if it came from an IRA, not from a pension plan. And finally, up to $10,000 can be withdrawn penalty-free for a first-time home purchase for yourself, your spouse, your children, your grandchildren, or your ancestors, provided that the home purchase occurs within 120 days of the distribution. So how do you claim an exception to the early distribution tax? Well, if you qualify for one of the exemptions I just listed, you complete Form 5329, Part 1, and on Part 1, you claim the exception code that applies and how much of the distribution qualifies for that exception. So in Part 1, you will enter the amount of the early distribution. You will also enter the early distribution amount that qualifies for the exception, and then you will enter the code that is appropriate for the exception you are claiming. And you will find that the codes, their descriptions, fairly much match each of the bullet points that I have listed here. And in a couple of situations, the code that you choose is the same as the code that goes on the 1099-R. And by that I mean that on a 1099-R, if you see a distribution code of 3, it means they're disabled and not subject to a penalty. And it happens to be if you fill out a Form 5329, the exception to the early tax penalty is the same code, code 3. And if you look down at code 4, that's distributions due to death. That's also the same as code 4 on the 1099-R. But none of the other codes are the same. It's just kind of a random thing I happen to notice that these two distribution exceptions to the penalty are exactly the same code numbers used when you are filling out the 1099-R for that particular category, but nothing else is the same. So code 1, if you qualify, if you take distributions from your retirement plan as a part of regular periodic distributions in a year after the year you reach age 55 or age 50 if the distribution is made for a qualified public safety officer such as a police officer or a firefighter, then the penalty does not apply. You would enter code 1 on the Form 5329. However, you may not use this particular exception code for distributions from IRAs. Or code 2, the distributions are made as part of a series of substantially equal periodic payments. And then we have disability code, we have the death benefit code. Code number 5 is used if you have qualified retirement plan distributions to the extent that you have deductible medical expenses that are claimed on line 4 of Schedule A. Code 6, qualified retirement distributions made to an alternate payee under a qualified domestic relations order. That's the divorce exception. And then we have code 7, 8, and 9, and I went and highlighted those for you as saying these only apply to IRA distributions. So if you do not see that the IRA box was checked on the 1099-R, even if your client did these things, they won't qualify for the exception. But firstly, code 7 is the code you use if they paid for health insurance while they were unemployed. Code 8 is the code you enter if they paid higher education expenses. And code 9 is the code if they purchased a first home. But again, in all three of these, they have to have taken the money from an IRA and not a 401k. Code 10, distributions due to an IRS levy. Code 11, qualified distributions to reservists serving on active duty for at least 180 days. And Code 12 is any other exception that might apply, including multiple exceptions. So perhaps your client qualifies for both the higher education exception and the first-time home exception, then Code 12 can be used. So here is the Form 5329. Box 1 is where you enter the amount of the early distribution. Typically this is the amount showing on the 1099-R. Line 2, in the space provided on this little line, you enter the exception code that applies. And on line 2, you enter the amount of money that qualifies for the exception. And then on line 3, you enter the amount of money that is still subject to the penalty. And on line 4, you enter the actual amount of the penalty. Password number 2 is LAND, L-A-N-D, LAND. Now there are other reasons why you would fill out Form 5329. Claiming an exception to the early distribution penalty is merely one of them. And actually, while I'm thinking about it, I should point out that the early distribution penalty or the additional penalty for taking money from a retirement account, those are kind of language used by tax professionals, but you won't find that terminology anywhere in the IRS publications or in the form instructions. The form instructions just refer to it as the additional tax. So even though I'm using the word commonly additional penalty or the early distribution penalty, that's not actually a word that's in the IRS publications. They simply refer to it as the additional tax. And 5329 is used for other things other than the additional tax on early distributions. It's used for other reasons as well. And one of these is the additional tax on certain distributions from education accounts. So Part 2 of the form is where if you took money from a Coverdell ESA and it was not a qualifying distribution from that ESA, the distribution can become partially taxable to the extent that there was income, and to the extent that there was income, there would also be a tax on that income. So whether or not you take a distribution from a Coverdell ESA and whether or not that distribution is taxable is going to depend on the facts. The purpose of opening up a Coverdell ESA is to save money for the beneficiary's higher education expenses, and it actually can be used for lower education expenses as well, sending your child to a private school such as K through 8. They might go to a private school rather than to public schools, and if you take money from a Coverdell ESA to pay for that, that's actually allowable. But if you take money from a Coverdell ESA and don't use it for allowable expenses, then any income earned in that account does become taxed, and it is subject to a penalty. But the penalty does not apply if the distribution is due to death or disability of the beneficiary, or it is made on account of a tax-free scholarship allowance or payment described in Section 25A, or it is made because of attendance by the beneficiary at a U.S. military academy to the extent that the distribution does not exceed the cost of advanced education, or number 4, included in an income because you use the qualified education expenses to figure the American Opportunity and the Lifetime Learning Credits. So number 4 is a rather interesting concept. It's basically saying I have qualified education expenses and I don't need to include the income from the ESA distribution in my income because I have qualified higher education expenses. But perhaps I'm also eligible for the American Opportunity Credit or the Lifetime Learning Credit, but I'm not able to claim those credits because I took tax-free money from my ESA. So in that situation, I'm going to choose to treat my ESA distribution as taxable so that I can then turn around and claim the credit. And if that exception applies to you, then you don't have to pay a penalty on the taxable distribution. Parts 3 through 7 of Form 5329 are used to pay the additional tax on excess contributions to traditional IRAs, Roth IRAs, Coverdell ESAs, Archer MSAs, and health savings accounts. A 6% penalty is imposed on taxpayers who contribute more to a traditional or Roth IRA than is allowed by statute. A 6% penalty also applies to excess contributions to Coverdell ESAs, Archer MSAs, and health savings accounts. The penalty applies each year that the excess amount is allowed to remain in the IRA. You determine the amount of the excess contribution and pay the tax. And you can see on each of these we have additional tax on excess contributions to a traditional IRA. The tax is 6%. Additional tax on excess contributions to a Roth IRA. The additional tax is 6%. Additional tax on excess contributions to Coverdell ESAs, another 6%. Excess contributions to Archer MSAs are 6%, and the additional tax on excess contributions to a health savings account is also 6%. How do you get out of that 6% penalty? Well, you can avoid the excess contribution penalty if you withdraw the excess by the due date for filing your return, including extensions. The withdrawal of the excess contribution amount is treated as a tax-free withdrawal if you do not take a deduction for the original contribution and you withdraw any interest or other income earned on the contribution while it was a part of the IRA. And of course, you have to include those earnings on your tax return as income for the year. And finally, there is one last little piece to Form 5329. That is Part 8. It is an 8-part form. And you complete Part 8 to figure the additional tax on excess accumulation in qualified retirement plans. You must begin receiving payments from your qualified retirement plan no later than your required beginning date. The government has established these dates to help ensure that payments are made out to you and your beneficiaries. The additional tax is 50% of the excess accumulation. So essentially, if you are subject to the required minimum distribution penalty, in other words, you were required to take a minimum amount out of your account and you did not, then you figure the penalty for failure to take that required minimum distribution in Part 8 of the form. And you can see right here the additional tax is 50%. There is a slight way out of this problem. You may recall that I mentioned earlier in today's class that I have a client who did not take the required minimum distribution from her plan because she was admitted to a nursing home for Alzheimer's. Obviously, she was not cognitive enough or aware enough to even know that she was supposed to be doing that. And it was only when her son brought me her tax documents that I was able to establish, hey, she should have taken required minimum distribution and did not. So I read through the IRS instructions for required minimum distributions, and there is some leniency that the IRS does have, and you would need to read the instructions for Form 5329 to determine whether or not your client might possibly qualify for relief from that penalty. And certainly I did request that for my client, and essentially we attached a statement to the tax return saying that she was not mentally cognitive enough to be able to make a decision about this, and that in a subsequent year that account has been completely drained and that there's no longer any money in it at all. Would they please provide an exception to the penalty? We filed for that exception just a couple of months ago, and I don't know whether the IRS has granted it, but it seemed to me to be good cause to ask for it. And since we're on the topic of required minimum distributions on Form 5329, I felt this was a good time to introduce the topic of required minimum distributions. You cannot keep retirement funds in your account indefinitely. You generally have to start taking withdrawals from your IRA or a retirement plan account when you reach age 70.5. Roth IRAs do not require withdrawals until after the death of the account holder. The minimum amount you must withdraw from your account each year is called your required minimum distribution. The RMD applies to all employer-sponsored retirement plans, including profit-sharing plans, 401k plans, 403b plans. The RMD rules also apply to traditional IRAs and IRA-based plans such as SEPs and Simple plans. And the RMD rules also apply to Roth 401k plans. However, the required minimum distribution rules do not apply to Roth IRAs while the account owner is still alive. So what is a required minimum distribution in terms of when does that date begin? Well, the annual minimum distribution from traditional IRAs, simple IRAs, and SEPs must begin by the year you reach age 70.5. And you can choose to delay receipt of the first distribution until April 1st of the year following the year you turn 70.5. Thereafter, the RMD for each year must be made by December 31st. And if the first distribution is delayed until April 1st of the following year, then the second distribution has to be made by December 31st of that year. So for example, you are retired and your 70th birthday was June 30th, 2012. You reach age 70.5 on December 30, 2012. You must take your first RMD by April 1st, 2013. In a second example, you are retired and your 70th birthday is a full day later, but because it's a full day later, you reach age 70.5 the next year on January 1st, 2013. That means you don't have to take a required minimum distribution for 2012, but you must take your first required minimum distribution by April 1st of 2014. Distributions after the required beginning date. The required minimum distribution for any year after the year you turn age 70.5 must be made by December 31 of that later year. For example, you reach age 70.5 on August 20, 2012. For 2012, then, you must receive the required minimum distribution from your IRA by April 1st of 2013, and then you must receive the required minimum distribution for 2013 in that same year by December 31st, 2013. So in other words, if you're able to delay taking your required minimum distribution until April 1st of the year following the year you turn age 70.5, then in that year where you've delayed out, you're going to have to take two distributions, one by April 1st and the other one by December 31st. Now, if the owner of the IRA dies after reaching age 70.5, but before April 1st of the next year, no minimum distribution is required because death occurred before the required beginning date. Even if you begin receiving distributions before you reach age 70.5, you must begin calculating and receiving required minimum distributions by your required beginning date. With Roth IRAs, there is no minimum required distribution during the lifetime of the owner of a Roth IRA, and following the death of the Roth owner, the required distribution rules will apply to the beneficiary instead. Qualified retirement plans other than IRAs. In general, you must begin receiving distributions from your plan no later than April 1st following the later of the year in which you reach age 70.5 or the year in which you retire, even if you are over age 70.5. There is an exception to that rule, though. If you own more than 5% of the employer maintaining the plan, you must begin receiving distributions no later than April 1st of the year following the year in which you reach age 70.5, regardless of when you retire. Required minimum distributions are not eligible for rollover, so amounts that are required to be distributed during a particular year, basically you have to include them in your income, and you can't defer them by rolling them into another account. So now what happens if in one year you take more out of your IRA than is required? Does that somehow carry forward to the next year and reduce the amount that you are required to take out in the next year? The answer to that is no. If you receive more than your required minimum distribution in one year, you cannot treat that excess, that is the amount that you took out that is more than the required minimum, as part of the required minimum for any later year. However, any amount that is distributed to you in your 70.5 year will be credited towards the amount that must be distributed by April 1st of the following year. Figuring the required minimum distribution amount. Well, there is a formula. The IRS has a series of tables that you refer to when you're trying to figure out the required minimum distribution. And figuring the required minimum distribution can involve a number of calculations depending on the complexity of the situation. I'm just kind of going to go over some of the simpler methodologies behind it, but if you are trying to figure the required minimum distribution for a client, it's best that you go to publication 590, read the full instructions, and make sure you know what you're doing. But this is just to bring you in touch with some of the rules for figuring the RMD amount. If you are the owner of a traditional IRA that is an individual retirement account, either you or the trustee is required to figure what the required minimum distribution is for each year. You figure your required minimum distribution for each year by dividing the IRA account balance as of the close of business on December 31 of the preceding year by the applicable distribution period or life expectancy for you. Now, for distributions during your lifetime, there are tables showing periods and life expectancies, and these are found in Appendix C of IRS Publication 590, Individual Retirement Arrangements. And here are the tables. Table 1 is called the Single Life Expectancy Table, and you use that if you are the beneficiary of an account. That is, you inherited the account as a beneficiary. Table 2 is the Joint and Last Survivor table, and if your sole beneficiary of your account is your spouse, and your spouse is more than 10 years younger than you, and you are figuring your required minimum distribution, then you use Table 2, which is the Joint and Last Survivor table. And finally, Table 3, this is called the Uniform Lifetime Table. If your spouse is not your sole beneficiary or your spouse is not more than 10 years younger than you, then this is the table you use, or your own required minimum distributions. And here is an example. It comes out of IRS Publication 590, and I inserted a cutout of the Table 3 so you could see how it works. Laura was born on October 1, 1941 and reached age 70.5 in 2012. Her required beginning date, therefore, is April 1, 2013. And as of December 31, 2011, the year before the year, her IRA balance was $26,500. No rollover or recharacterization amounts are outstanding, and if there were, you would use that. They would add complexity to the problem. So in this case, they don't apply. So we go to the Table 3, the Uniform Lifetime Table, and this table, by the way, is used by unmarried owners or married owners whose spouses are not more than 10 years younger, and married owners whose spouses are not the sole beneficiaries. We find the age of the beneficiary, Laura, 71, and we follow that across and see that the distribution period is 26.5 years. According to the tables, based on her retirement age, the IRS expects her to live 26.5 years. So she takes her balance in her account and divides that by 26.5 years. And when she does that, her required minimum distribution then would be $1,000, and that amount must be distributed to her on or before April 1st of 2013. In example number 2, also from Publication 590, Joe was born on October 1, 1941, and he reached age 70.5 in 2012. His wife, who is his beneficiary, turned 56 in September of 2012. He must begin receiving distributions by April 1st of 2013 as well. Joe's IRA account balance as of December 31, 2011 is $30,100. Now, because Joe's wife is more than 10 years younger than Joe and is the sole beneficiary of his IRA, Joe is going to turn to Table 2 in Appendix C. And we have a cutout of Appendix C here, and we've essentially followed the line across where we have his age at 71, and then we find her age at 56. Those two merge at this point on the table to 30.1. Based on their ages at the end of the year, December 31, 2012, the joint life expectancy for Joe, age 71, and his wife, age 56, is 30.1 years, and therefore we're going to take 30.1, divide that into 30,100, and again we come up with that same result that the minimum distribution is $1,000. Required minimum distributions for an account holder in the year of death. The required minimum distribution for the year of death is determined in the same manner as if the account owner had lived the entire year. If the account holder did not take a required distribution prior to death, the beneficiary who inherits the account must take the owner's required minimum distribution by the end of the year. If the owner died prior to the required beginning date, then no distribution is required for the year of death. Required minimum distributions to spousal beneficiaries. If you inherited an IRA from your spouse, your required minimum distribution depends on whether you elected to treat that IRA as your own or whether you have elected to be treated as a beneficiary. If you choose to treat your deceased spouse's IRA as your own IRA, then you apply the RMD rules as they would apply to you as the IRA owner, and that is you must begin to receive distributions by your required beginning date. Now, if you choose to treat the IRA as a non-spousal beneficiary IRA, you can postpone distributions until December 31 of the year the account owner would have reached age 70.5. RMDs to non-spousal beneficiaries. If you are a non-spousal beneficiary, you can withdraw the entire account balance by April 5th of the year following the account owner's death, if the account owner died before the required beginning date, or you can calculate the required minimum distribution using the distribution period from the single life table that is based on one of the following. Number 1, if the owner died after the required minimum distributions began, then you use the longer of the beneficiary's remaining life expectancy determined in the year following the year of death reduced by one subsequent year, or the owner's remaining life expectancy at death reduced by one for each subsequent year. Or, number 2, if the account owner died before the required minimum distributions began, then you use the beneficiary's age at year end following the year of the owner's death, and then you reduce the distribution period by one for each subsequent year. Rules that apply to non-spousal beneficiaries. The following rules apply if you are an IRA beneficiary who is not the surviving spouse of the account owner. Firstly, the 10% additional tax does not apply to the distributions, and that means on the 1099-R you should see a code 4 in box 7. Now if you've got a 1099-R that is from an inherited account and you are the beneficiary, it should show a code 4, and if it doesn't, then you would attach Form 5329 to your tax return and use exception code number 4. And of course you really should contact the trustee of the account and let them know that they've put the wrong code on there, because that would be the case. Also, you cannot treat the IRA as your own. This means you cannot roll any distributions from that IRA into your own IRA accounts, but you can make the trustee-to-trustee transfer that we talked about earlier. And also, you cannot make any contributions to your inherited IRA.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
Classwork assignment is one of the easiest assignments I'll ever give a student of mine. Our taxpayer is named Jane, and she purchased her first home. She withdrew money from her IRA to make the $20,000 down payment on her home 100 days before she purchased it. Her 1099-R is attached. Go ahead and prepare her 5329. Classwork assignment number 2 involves a character named Jack Taxpayer. He's age 50 and single, and took an early distribution from his traditional IRA during the year because he lost his job. His total cost basis in all IRAs on 12/31/11 was $50,000, and he made no contributions to any IRA during 2012. Jack spent $2,000 for health insurance while he was unemployed, and he received the attached tax documents for the year. Prepare his return. So we've got the 5498 for Jack Taxpayer, showing that the fair market value of his account on the last day of the year was $100,000. And just as a reminder, he has a basis in all of his IRAs of $50,000, and he's age 50. So here is the 1099-R for the IRA that he took $20,000 from. And it's showing the distribution code of 1. It's showing that it is an IRA. It's showing how much tax he had withheld. He also has a W-2 for $30,000, and your job is to prepare his tax return.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
So here is the answer key for our first illustration of the day, which was for Jane. And of course, Jane took an early distribution from an IRA. So looking at her 1099-R, you should have seen that the IRA box was checked. And she did spend $10,000 to purchase a first home, and she purchased it 100 days after she took the distribution. The rule is that you have to take or make that first home purchase within 120 days of the distribution, so she met that test. But of course, there's a limit on the amount that she's allowed to exclude. That limit is $10,000, and since she took $20,000 from her IRA, she's going to be left paying a penalty on the remaining $10,000. So on line 1, we enter the amount of the early distribution, which was $20,000. On line 2, we enter the amount of the early distribution that is not subject to the penalty, and we enter the reason why there's no penalty that applies, and in this case that's exception code number 9 for qualified first-time home purchase. We then do the math, which is to subtract the amount not subject to the penalty from the total distribution. We end up with $10,000 that is subject to the penalty, and that leaves $1,000 at 10% of $10,000 as being the amount that's subject to the penalty. So Jane is going to report $20,000 of distribution on line 15 of her 1040. All $20,000 is taxable. And in addition to paying tax on $20,000 of distribution, she will also pay a penalty of $1,000 on the remaining distribution. And that is her answer, or the answer for Jane. So let's remember a little bit about Jack's tax scenario. Jack's scenario is that he has a basis in an IRA. He's taken a distribution from his IRA, And he's going to have to figure out how much of the distribution is taxable because he has a basis. And on top of that, because he's under age 59 and a half, he's subject to a 10% penalty. However, in the wording of the problem, I told you that he paid for health insurance while he was unemployed, and he spent $2,000 on health insurance while he was unemployed. And so he's going to qualify for an exception to the penalty on $2,000 of his distribution. So that's why his taxable part of his distribution is $11,667, but the penalty that is 10% is 10% of the taxable distribution minus the amount not subject to the penalty, $2,000. So let's see how all that works. The answer key, as you can see, is very descriptive. I'm not going to read the description to you. It's there if you want to read it on your own quietly after class is over today. But here is Jack's 1040, and we're going to start. If I can just get it up here for you to see the whole form. That we're entering, obviously, his name and his address. We're selecting the filing status of single. We gave you a W-2 for Jack, and the W-2 showed that he earned $30,000 for the year. We also give you a 1099-R showing that he took a distribution from an IRA and that his distribution totaled $20,000 for the year. The mystery is, how do we arrive at the number 11,666? Rounding in the answers I gave you, I came up with 11,667. Our software rounded it down $1 to 11,666, but either way, we're going to get to roughly the same point. His adjusted gross income is 41,666. We move over to page 2. He claims a standard deduction, a personal exemption. He figures his tax, and his tax bill for the year is $4,354. And to that, we're going to add the penalty on line 58, which is $967. And he had $5,500 withheld, so he ends up with a little tiny refund of $179. So the big mystery for you is, what does the 8606 look like and the 5329 look like? The form order put the 5329 first, but I'm going to go to the 8606 first because you really can't do the 5329 until you've done the 8606, right? So on form 8606, we start with his total basis in his IRA, and I told you that in the wording of the problem. It's $50,000. And the 5498 form told you that his balance in his account at the end of the year was $100,000. And his 1099-R told you that he took a distribution of $20,000. So we add 120 and we enter 120 on line 9. And then the math says, take his cost in the plan, divide that by the number on line 9, and get a percentage and put that on line 10. We then take this percentage and multiply it by the distribution to get the amount that he does not have to pay tax on. The tax-free recovery is $8,334. We take $8,334 and subtract that from the distribution amount of 20, and we get the taxable amount of the distribution, which is $11,666. We also take $11,334 and subtract that from 50 to arrive at his new year-end basis in his account for 2012. In future years, his basis will now be $41,666. If he fills out this form again in 2013, $41,666 will become the number he puts on line 2. We then go over back to the 5329 form, and we use that taxable amount of the distribution, $11,666, and we enter that on line 1. We then say, okay, what is the amount of money that he spent on a qualifying exception? And that amount of money was $2,000, and the exception code for unemployment benefits while you are, or not unemployment, but for health insurance while you are unemployed, the code for that is 7. So he enters 7 on line 2, and then he subtracts line 2 from line 1, and he gets $9,666. He multiplies that by 10% and gets the penalty of $967. So those of you who are able to figure that out, congratulations. And me, without thinking very clearly, had leaped to 1,167 as the penalty when it truly is $967 because we have to factor in $2,000 not subject to the penalty. But the $2,000 is still taxable. So the taxable amount entered on the front page of the 1040 is still $11,666, but the amount subject to the penalty is $2,000 less, and therefore the penalty is 10% of $9,666. So that's the conclusion to that particular problem. And we're at a point where I could legitimately give you a full 10-minute break for our final hour, but I figure that what I'm going to do with the final bit of our class today is we've got a more complex assignment, and I'm going to combine our next break with that assignment, if you can bear with me, because it's kind of it's an important assignment. If you haven't ever done this particular hand calculation before, you should definitely know it, because there's going to be a time in your career where you have to do it. And my experience is that tax software does not do that calculation for you. You have to do it manually. Password number 3 is Aloha. A-L-O-H-A. Aloha.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.